Guys, welcome back to actually our final chapter dealing with dealing with accounting two. Um, this chapter is probably one of my favorite chapters. The reason why is because we actually can now apply or make inferences about a company based on everything we did in the past, right? Up to this point, we learned how to, well, account for a number of activities, a number of transactions within a company, right? We can, we know how to report income, how to prepare journal entries to recognize income based on the accrual method, right? We saw how to apply depreciation and calculate depreciation. We saw how to handle investments, right? So up to this point, it was all technical as far as here's what the company did, do the journal entry, prepare the financial statements. This chapter actually allows us to analyze those financial statements. So we're gonna gain some tools, or we're gonna learn about some tools that we have to um, to analyze a company and say, okay, is this company financially viable, right? So we're going to look at financial statement analysis. We're going to look at um, how to apply both horizontal and vertical analysis to those financial statements. We're also going to get into the ratio analysis, and we're going to be able to analyze the company's performance based on those ratios that we're gonna go through. And then finally, we're going to discuss the concept of sustainable income. Okay, so we don't have a lot of learning objectives here, just three easy ones. Um, we'll get into the ratio analysis too. We'll spend a lot of time discussing what exactly these ratios are and what they help us, how they help us understand the performance of a company. Okay, so in this video, we're strictly going to look at how do we apply both horizontal and vertical analysis to financial statements, right? But we need to recognize first that in order to do vertical and horizontal financial analysis, there's certain characteristics, um, certain steps, I guess you could say, or certain tools rather, that allow us to analyze financial statements, right? First of all, by analyzing financial statements, we understand we glean an understanding of the firm's characteristics. In order to understand the characteristics of a company, we're really asking what's the company's solvency? How solvent is the company? Is the company profitable? How much liquidity does the company have? Okay. Now, those numbers by themselves, profitability, solvency, liquidity, even looking at using those tools of horizontal analysis, vertical analysis, and ratio analysis, those characteristics by themselves tell us nothing. Okay. Um, if we look at ratio analysis and we say, okay, the liquidity of a company based on the current ratio is one. Well, what does that mean, right? What's a one? The point is, when we conduct financial statement analysis, we need something to compare our numbers to. So we need a comparison basis, right? We can use a number of things for that comparison, right? We can use intracompany numbers, right? We can use industrial averages, or we can use intercompany, um, kind of like an intercompany benchmark. Okay, basically, what we're saying here is we have tools to analyze the financial statements. What are we going to look at? We're going to look at liquidity, profitability, solvency. We can't do that alone. We need something to compare it to, right? We need a benchmark. We can either use past performance of the company, right? Last year, we had a liquidity ratio of 1. This year, we have a liquidity ratio of 1.2. Okay, well, I'm comparing it to my prior performance. I could see in the new year my liquidity increase, so that's going to be good, right? Um, we can use things like the industrial average, right? Um, I don't know, um, Yahoo Finance or Google Finance or Morningstar. Um, they provide financial information based on a company's industry or a company's sector, right? So we can look at our liquidity, our profitability, our solvency of our corporation, and we can compare how we stand compared to our competitors that are in the same industry as us or the same sector as us. Okay. So, first thing we're going to look at is horizontal analysis. Now, horizontal, up and down. That's all you need to remember, right? And when we look at, or I'm sorry, that's vertical. Horizontal goes across. It's too early. Horizontal goes across, right? So, when we're looking at horizontal analysis, we can also call this trend analysis. And what trend analysis or horizontal analysis allows us to do is to evaluate a series of financial statement data over a period of time, right? So we can look at liquidity over the past 5 years and how did our liquidity change over the past 5 years. Um, we can also look at our inventory turnover, any of the financial ratios that we're going to look at. Basically, what we're doing is just comparing the numbers to prior years' performances. That's all it is. Okay. So, horizontal analysis allows us to determine was there any increases or decreases in our in certain financial statement items. Okay. We can apply vertical analysis to the balance sheet, the income statement, and the statement of retained earnings. Okay, so basically, those are our three major financial statements that we looked at um, over last semester and this semester. Okay, so we can look at cash or we can look at investments um, or accounts receivable. We could say, okay, what's the trend, right? Has our accounts receivable increased over the years or has it decreased over the years? Excuse me. So the main takeaway here is just recognizing that what is horizontal analysis evaluates a series of um, financial data over a period of time, and we can apply horizontal analysis to balance sheet items, income statement items, and statement of retained earnings. Excuse me. So what we see here is an example of horizontal analysis. Notice we have the balance sheet, right? We have the classified balance sheet. It gives us the current assets, plant assets, intangible assets, the liabilities, and it compares two different time periods, right? 2012 and 2013. So what we're doing is comparing the two numbers. So look at current assets. In 2012, our current assets were $945,000. In 2013, current assets were $1,020,000. All we need to do is take the difference between the two, and we have the amount change. We can also calculate the percentage change. Okay, so if you notice, whenever we're doing horizontal analysis, how do we set this up? This is what you need. This slide will help you conduct horizontal analysis. Notice we have the comparative balance sheet, and then we have two additional columns. One that shows the increase or decrease in the amount, and then we calculate the percentage change. Okay. So we could see what areas increased, what areas decreased over a period of time. We could do the same thing to the income statement, right? We can apply horizontal analysis to the income statement. So one of the major items on the income statement obviously is going to be our sales revenue, right? We can look at our sales revenue and say, okay, how did our sales revenue change from 2012 to 2013? Well, first we want to calculate what's the difference, what's the amount difference, right? So we just subtract 2013 from 2012. We see that our sales revenue actually increased by $235,000 from one year to the next. We calculate that as a percentage. We see it's 12%. Okay, so we had a 12% increase in revenue. Excuse me. Look at our sales returns and allowances, right? We see that it actually decreased from 2012 to 2013, right? Again, take 2013, subtract 2012 numbers, so 98,000 minus 123,000. Our returns and allowances decreased by $25,000. That's a percentage change of 20.3%, right? Now, what does that tell us? Well, it tells us our sales returns and allowances went down. Does that mean we did a better job manufacturing or we did a better job selling products that customers wanted, right? We had good products that weren't, that didn't need to be returned, that weren't defective or anything like that, right? So again, we learned how to do the journal entries and record everything. Now we can actually analyze and say, how are we doing? Are we doing better? Are we doing worse? What are we comparing it to, right? So horizontal analysis, very, very useful, especially when analyzing a company. Okay, we could do that. We can also apply again horizontal analysis to the statement of retained earnings. Right. Again, the main takeaway here is what are we subtracting? Well, again, we're looking at each item and we're comparing the change, or we're calculating the change. So look at net income, right? Net income in 2008 was $208,500. Net income in 2013 was $263,800. So that means our net income actually increased from 2012 to 2013 by $55,300. Cool, right? That's definitely something positive that we want to see in a company. And we can calculate that percentage change. So our net income actually increased 26.5%. Okay. The next thing we have is vertical analysis. Okay, vertical analysis goes up and down, right? And we call vertical analysis common size analysis. Okay, what it does is it allows us to express items within each financial statement as a percentage of some base. Okay, so on the income statement, right, we might say selling expenses are 16% of net sales. Let's go back to vertical analysis, right? Vertical analysis says we're going across, right, over time. So we're saying, gross profit increased by 17.1%. Selling expenses increased by 19.6%. Administrative expenses decreased from one year to the next by 4.1%. What we're saying in vertical analysis is we're looking at all those expenses, right? Or we're looking specifically at selling expense. And instead of comparing 2012 to 2013 and how that changed, we said, no, we're going to look at just 2013. And we're going to take our selling expense, and we're going to divide that by net sales. So we're going to report each item as a percentage of some base, okay? When we conduct vertical analysis, we only need two financial statements. We need the balance sheet and we need the income statement. Okay, so let's look at how do we set up vertical analysis? Well, notice we have the amounts for each year, and then we have the percentage, okay? Excuse me. So what we're doing is we're saying that, okay, usually when we're using vertical analysis and we're comparing it to the balance sheet, we need some base, right? That base is going to be usually total assets, okay? So we could say that, okay, well, let's look at um, current assets, right? Current assets compared to the total assets, right? So we just divide, right? Total assets by current assets, we get a percentage. And what we're saying here is basically, okay, total assets are $1,835,000, right? Current assets current assets as compared to total assets, current assets make up 55.6% of our total assets. Same thing with net plan assets. $1,835,000 divided by the 800,000. We say that net or plant assets consists of 43.6% of our total assets. Okay, and then we do the same thing we go through all the liabilities. Well, our current liabilities are 18.8% of total assets. Same thing with long-term liabilities. Well, long-term liabilities compared to total assets is 26.5%. Okay. Again, if I were you, I would put this in my notes because this is really a helpful hint, right? There's a formula for calculating the balance sheet percentages. It's each item on the balance sheet, so we'll take current assets divided by total assets. Same thing with long-term liabilities. We'll take our long-term liabilities. That's an item on the balance sheet. We're going to divide it by our total assets. Okay. Looking at the income statement, right? What this allows us to do is, again, we're comparing each item within a year, okay? We're comparing that to some base. So notice the helpful hints. I'd put this in your notes, right? What's the formula for calculating net income percentage? Well, we take each item on the income statement and we divide it by net sales, okay? So we said our selling expenses, in the previous example, we said 16%, right? How did we get that 16%? Well, they just gave us the numbers, right? At 16%, okay? But look how we calculated that. We took our selling expenses of $253,000 and we divided it by our net sales, which is $2,097,000. And we see that selling expense is 12% of our total net income. Okay. Oh, sorry. So again, what we're trying to do when we're looking at vertical analysis is we're trying to determine, is the company profitable, right? And this is just one way of doing that, looking at vertical analysis. So this company does appear to be profitable, right? The reason why, sorry about that. The reason why is we could see that, look at our net income. Net income, $263,800 divided by net sales, $2,097,000 is 12.6%. We could compare that to 2012. Well, in 2012, we're doing vertical analysis. So we're taking the net income that we got or that we earned in 2012, $208,500, and we're dividing that by 2012's net sales of 1,837,000. We get 11.4%. So we could see that as a percentage of sales from one year to the next, net income was a larger portion of our net sales. Um, when we're doing vertical analysis, right, this really helps us to compare companies that are really of different sizes, right? I want to compare quality department with Macy's, right? Well, we can assume that just by looking at the numbers, Macy's is a bigger company than quality department store, right? So if we look at it and we look at the net sales, right? $2,097,000 for quality department compared to Macy's $27,931,000. Just by looking at that, can we tell that one company was more profitable than the other? One company had more sales than the other? Well, we can't really say that quality department is a less successful store than Macy's because they're two different sizes, right? So what vertical analysis allows us to do is compare two different size companies. So look at the net income, right? Quality department, their net income as a percentage of sales is 12.6% compared to Macy's, which is 5.3%. So even though Macy's is much larger, does much more volume than quality department, we could say, well, based on the net income, based on the fact that for every dollar every dollar of net sales, 12, 12.6 cents ends up becoming net income compared to Macy's. For every dollar Macy's sells or has in net sales, 5.3 cents goes to net income, right? So we could say that, well, based on that, quality department store seems to be running more efficient or more effectively, okay? We'll go through examples of horizontal and vertical analysis in our demo video. And then after that, we'll talk about ratio analysis. But right now, I just want to make sure that we understand, or the concepts of horizontal and vertical analysis, right? When we're analyzing financial statements, we need there's three items that go along with that, right? The characteristics, we need a comparison basis, and we have tools to use, right? In this video, we're looking at two tools, horizontal and vertical analysis, okay? Remember horizontal, also called trend analysis. You need to know what the purpose is. Why do we do horizontal analysis? Well, we want to determine the increase and the decrease, right, in certain items. What's it applied to? Well, we can apply it to any of the financial statements, the balance sheet, the income statement, or statement of retained earnings. We demonstrated how to set up horizontal analysis. Okay, what's vertical analysis? Well, vertical analysis, common size analysis is another name for it. You need to know that. It's a technique that expresses each financial statement item as a percent of some base amount. Okay, so you need to know that. You need to know vertical analysis. What financial statements is it applied to? Well, it's only going to be the balance sheet and the income statement. We saw how to set those up. I gave you your helpful hints of the equations. Definitely should write those down. Okay, so now we have enough. We know enough about the concept, the calculations. We can actually go apply this now. So tune back in for our demo video where we discuss, okay, let's take this information that we have, and let's conduct vertical analysis. Let's conduct horizontal analysis. So tune back in for that video.